Here's the biggest mistake young people make with money. I'm still young, I don't have to worry about money yet. I used to think the same thing. But here's what nobody tells you about time as a young person. It's either your greatest asset or your greatest liability. The difference comes down to one simple thing most people get completely wrong about building wealth. They chase doing what they love instead of acquiring what they love to own. And if you mess this up in your 20s and 30s, you'll end up like some people who are 70 years old making good money, but have absolutely nothing to show for it. Hi, Kane here. I'm a theater grad that started with nothing. 20 years later, I own properties throughout Ontario. Check out my biography video to learn about my story. Also, the information pulled from this video is from Robert Kiyosaki, a financial author. Please see the description below for the references. If there are any discrepancies, please let me know. Also, this information is for educational purposes only. Please seek legal financial assistance if you are considering to invest. Without further ado, let's get started. The real danger is that time becomes your greatest asset or your greatest liability depending on what you do with it. Most people don't understand this until it's too late. When you're young, compound growth can work miracles for your wealth. But every year you delay means losing that compounding potential forever. That lost opportunity creates a permanent wealth gap that becomes incredibly difficult to close later in life, even with a high income. Some people who are 70 years old make over $100,000 per year. They have nice houses and nice cars. They look successful. But when you look at their bank accounts and investment portfolios, they have nothing. They spent 40 years earning good money, but never built any real wealth. They fell into the lifestyle trap where every raise just meant a bigger house payment or a newer car loan. The math gets worse every year you wait. Time is either working for you or against you. Your wealth either grows exponentially through compound interest or you lose decades of potential growth that you can never recover. Your 20s and 30s are when your financial habits get set in stone. One can see that by age 40, most people have locked themselves into a lifestyle that requires their entire paycheck just to maintain. They can't invest because they need every dollar to pay for the house, the car, the vacations, and all the other things they convinced themselves they needed when they were younger. The I'm young mindset is death to most people. You think you have plenty of time to figure it out later, but later never comes because you keep pushing the problem down the road. Once you spend that time on fun and excitement without building assets, you can never get that time back. Each year makes it harder to catch up. Each year requires more sacrifice to achieve the same result. The solution requires doing uncomfortable work in your 20s. Learning about taxes, debt, insurance, and legal structures isn't fun, but these are the tools that let you build assets instead of just earning a paycheck. Most people avoid this education because they want immediate comfort. They want to do what they love instead of what creates wealth. This keeps them trapped in the employee mindset, trading time for money in ways that guarantee they'll never escape the cycle. But there's a system that explains exactly why this happens to most people. As shown in Kiyosaki's literature, this system divides all ways of making money into 4 categories. You're either an employee, self-employed, a business owner, or an investor. Most people spend their whole lives stuck on the left side of this system as employees or self-employed professionals. When you're an employee, you trade your time directly for money. You show up, work your hours, and get paid. When you're self-employed, you still trade time for money, but you work for yourself instead of someone else. These are often specialists like doctors, lawyers, web designers, and consultants. They might make more per hour than employees, but they're still selling their time. The tax burden here hits 60% because they pay CPP, EI, and income taxes. The right side works differently. Business owners create systems that make money without them being there. The B quadrant specifically refers to big business with 500 or more employees. These entities get a tax rate of 15% because they create jobs and serve more people. Investors use their money to make more money through stocks, real estate, or other investments. Professional investors often pay 0% in taxes through legal strategies, and this is where the megabucks are made, though it requires the most time and education to achieve. Here's the key difference between left and right. The left side operates from passion, which is greedy because it focuses on what you want to do. The right side operates from purpose, which focuses on serving others. Following your passion usually keeps you trapped on the high tax left side. If you love photography, you become a freelance photographer trading time for money. If you love fitness, you become a personal trainer working by the hour. Your passion becomes a job that limits your income and taxes you heavily. The same person doing the same work pays different tax rates depending on which box they operate from. A photographer working as an employee might pay 40% in taxes. The same photographer running a photography business might pay 15% in taxes on the same income. The left side has a built-in ceiling because you only have 24 hours in a day. Even if you charge $500 per hour, you can only work so many hours. The right side has no ceiling because systems and investments can scale without your direct involvement. Moving from left to right requires learning things most people avoid. Again, you need to understand taxes, legal structures, insurance policies, and accounting systems. But understanding how to work differently is only half the equation. The other half is understanding the asset ladder most people never climb. Rich people don't just work differently, they own different things. There are 4 types of assets that wealthy people focus on: business, real estate, paper assets, and commodities. Most people never learn about all 4. They stick to 1 or 2 and wonder why they stay broke. Business sits at the foundation of this system. It provides the cash flow that funds everything else. When you own a profitable business, you generate money to buy real estate. You create income that lets you invest in paper assets. You build wealth that lets you buy commodities as insurance. Most people can't do real estate effectively without a business to provide income first. The banks want to see cash flow before they give you loans. Each asset class follows the liquidity principle. Paper assets like stocks and bonds are the easiest to sell. You can log into your account and sell shares in minutes. Real estate takes months to sell. You need to find a buyer, get inspections, handle paperwork, and wait for closing. Business can take years to sell. The less liquid the asset, the higher your financial IQ must be, because mistakes in illiquid assets can't be quickly fixed. Paper assets are like training wheels for investors. They're safe because you can get out fast. But most people who only own stocks and mutual funds never get rich. The returns are too small and the fees eat up your profits. These work fine for retirement accounts, but they won't make you wealthy. Real estate builds long-term wealth because property values go up over time and tenants pay your mortgage. But you need cash flow from somewhere else to buy your first properties. Real estate investors who succeed usually own businesses first, similar to a client of mine that used his telecom company that he formed and operated for over 15 years to buy several apartment buildings. Commodities include tangibles like gold, silver, solar panels, and food that provide value regardless of the economy. These protect you when inflation hits. When the dollar loses value, commodities hold their worth. People always need to eat regardless of what happens to the stock market. Many people chase shiny objects instead of building this foundation. Bitcoin and cryptocurrencies are popular, but they're shiny objects that people chase for quick money rather than building long-term assets. Kiyosaki's mentor once sent him to Lima, Peru on short notice to look at gold mines. The airfare cost $20,000. When he got there, there was nothing there. It was a test of how badly he wanted to learn and how much guts he had. The shift from employee thinking to investor thinking means changing what you love. Stop loving what you do for work. Start loving what you own. But most people never make this shift because they think they have all the time in the world to figure it out later. The solution requires changing your entire approach to money. Stop chasing what you love to do for work. Start acquiring the assets you love to own. You will thank yourself for doing the uncomfortable work when you are young instead of playing catch-up later. The only way to move from the high-tax left side of the quadrant to the low-tax right side is to invest in your financial education. Learn about debt, taxes, and insurance while your friends are still figuring out their passion. These subjects aren't exciting, but they're the tools that separate the wealthy from the broke. Most people have the ability to be smart enough for real investing. The real question is whether you're willing to do the study and work required. If you enjoyed this material, be sure to watch my next video on how you can get started with this mortgage investment that will generate money while you sleep.